the market has already taken a lot of comfort in the selection of Warsh. We just see macro tailwinds. It's really about the CapEx cycle, the global industrial renaissance, and whether or not rates move a little bit on the front end isn't really going to change these macro opportunities. And so when we think about our business across credit, hybrid, and equity, when we think about the needs for capital here in Asia, we don't really think it's going to change the answer that much.
Really? Okay, but okay, let's take a look at the 10 though. It's been pretty sticky. We're at about 424 on the 10. That's going to matter to consumers, obviously, to potentially mortgages as well, to the economy, and obviously come November to the midterms.
Sure. When you think about the sources of funding, particularly here in Asia, still about 80% of funding is from the banks. And if you compare that to Europe, it's about 50%. If you compare that to the US, it's about 30%. So we still think there's an enormous amount of growth for the private markets. Now, if you're thinking about long-term CapEx, if you're thinking about the energy transition, if you're thinking about AI, again, the short end of the curve or rates in the near term isn't really going to change those macro tailwinds.
Okay, what do you tell investors, though, or people you meet who find out you're in private credit very, very heavily and go, well, look, you know, this whole AI boom, yeah, it's probably still got legs left. CapEx is still ramping, but, you know, they're pretty much up to here in terms of funding it from free cash flow. They're turning to debt, including to private markets where I can't see a thing.
Sure. You know, we're celebrating 20 years in Asia, and like you said, we have all 200 Apollo partners here for this week in the region, and we have our global partners offsite later this week. So we're so focused on the opportunity set to help companies invest and grow. As it relates to AI, I think the front end of the curve is pretty clear. So the changes, the cash flows, there's a lot of certainty on the front end. I think it's the longer term that's a little less certain, and so we're aligning ourselves to that. By being in credit or in hybrid, we're focused on the short end. That's really where we've made the majority of our investments, whether you look at Valor or where you look at financing data centers like we've been doing. We haven't really made equity investments in AI because we do think the longer term is uncertain.
Okay, all right. Sherry, come in on this.
Yeah, Matt, it's great to have you on. Thank you so much for joining us. Do you think that this year could be the window, because we're sort of in this midterm election cycle, and really depending on how the election goes, it can sort of weaken or embolden the Trump administration, and some of the bank deregulation drives that he was known to go for, and so on, and of course rate cuts is really the front and center. Do you think this is really the year that the cycle really picks up in terms of M&A and the deregulation story, and it could actually sort of bring in more liquidity into the system? And does that actually help your business, or does it sort of take away some shine from what you're trying to do here?
Well, I would focus on the corporate market, and then I'd compare that to the private equity market, because I think the trends are different. I think in the corporate market, M&A is a referendum on confidence, and there is a lot of confidence for the reasons that you mentioned. And so 2025 was a big year for M&A, and we see those trends continuing throughout the course of this year. I think the private equity market is a different story, and I think the private equity market is very bifurcated. There's a $4 trillion overhang on the private equity industry. So these are stranded assets or assets that haven't been able to monetize yet. And we see that playing out over a long period of time. It's not that the private equity industry bought bad companies. They bought good companies. They just overpaid for those assets. And so it's going to take a while for the industry to continue to correct and continue to return capital. And the lack of realizations has been a big issue for PE. As it relates to our PE business, we've really held on to our discipline. We talk about purchase price matters. As a result of the discipline that we held on to over the last couple of years, and particularly coming out of the pandemic, our performance has been very strong. Our realizations across our private equity portfolio have been materially better than the industry. Across the entire business, we do think that the M&A market is going to create opportunities for us, whether it's financing companies with credit solutions or hybrid solutions, or continued growth in our private equity business.
What kind of market moment, do you think it will be when SpaceX, for example, goes public? Because I wonder, because it's been sort of locking up a lot of money for such a long time, it could be a major distribution event, and perhaps that liquidity gets put back into the market. Do you have a line on that? And you don't have to, comment on SpaceX only, but we are hearing whispers about major tech juggernauts actually getting ready for their IPO moment.
For us, I think it's more about our investors and thinking that they should have exposure to public equities and to private markets assets as well. If you look at the public equity markets, particularly in the U.S., massively concentrated. So 8,000 public companies have gone to 4,000. 10 stocks really generated a lot of the gains last year, represent about 40% of the returns to the S&P. And even though the S&P was up 18% last year, a third of companies actually lost value. And so the public equity markets play a role in investors' portfolios, but we think the private markets offer longer excess return over longer periods of time, more diversification, and is very much a complement to people's public markets exposure.
And you mentioned, you used the word discipline to describe how you're approaching, especially when it comes to the private equity market. That was definitely the narrative playing out, especially around the whole AI situation and people who actually bought at such high levels during COVID, not being able to come out of their, not being able to exit from some of their investments. What do you think now? What kind of point are we in this cycle? Do you still need to exercise that discipline to pick up some of these investments, or do you think valuations has come off quite a bit because of a lot of the bubble talk that actually happened over the last few months?
For our strategy, for 35 years, Apollo's had this philosophy of purchase price matters. So no matter what the market environment is, we're going to pivot to where we see the best risk reward. We're always going to have this discipline, this focus on downside protection. That's true in our private equity business. It's true across the entire platform, credit and hybrid. If you think about where we're seeing opportunities right now in private equity, I do think this bifurcation in the public equity markets is creating a lot of opportunities. So the fact that you have fewer and fewer investors really doing price discovery, given the shift to passive, you're finding very high quality businesses that we can take private at a reasonable price, capitalize them well, and so you're somewhat insulated from any short-term volatility. And if you are making a private equity investment, you are thinking about the longer term. Corporate carve-outs has also been a big area of deal flow for us. We carved out the Panasonic automotive business in Japan last year. We're very excited about that opportunity, and I do think you're going to see us do even more corporate carve-outs, particularly in Japan.